everyone and welcome to my channel. My name is Nick and I am a software engineer turned investor. My goal and the mission of this channel is to bridge the gap between technology and investing. By doing so, I plan to help everyday investors to understand complex technical subjects like artificial intelligence, data science, blockchain, cryptocurrency, and many more, so that they can have the knowledge and confidence to stay invested in high growth companies no matter what the stock market is doing in the short run. But before I start doing that, I want to bring as many people on board as possible. Therefore, this is the second part of a general guide to building wealth from scratch. In this video, I will give you the last 5 steps out of 10 in order that you can take now to start your journey to financial independence and personal wealth. And if you wait until the end, there will be a bonus step. A step that, in my opinion, is the most important of all. That being said, let's get started. The 6th step is understanding compound interest. The human brain is not wired for exponential growth. We simply cannot understand and imagine it. There is a thought experiment in the book Abundance by Peter H. Diamandis and Steven Kotler. The experiment goes as follows. If I asked you to go out your front door and take 30 steps, I am sure that you could guess about where you'd end up without even taking the walk. But what if I ask you to take 30 exponential steps? That is to say, double the size of your step each time. Where do you think you'd end up? The answer? You'd go around the earth 26 times. Crazy, right? Now, let's apply that thinking when it comes to money. The average 10-year return for the S&P 500 index is 13.6% annually. So if you would invest $100 per month with a 13.6% yearly return for 30 years, you would retire with $400,000 while only investing $36,000 of your own money. There is a tool called Compound Interest Calculator. It is free and the link will be in the description. I encourage you to play around with it and try to map out scenarios that are realistic to your situation. Step 7 is to invest your money now. Without exigent circumstances, the average inflation rate is 2 to 3% per year. That means if we apply the same exponential logic from the previous step, if you have $100 now, they will be worth roughly $50 in 30 years. No one can predict what the market will do in the short run, but it doesn't really matter if you have a multi-decade horizon. Timing the market wins over timing the market any day. And if you think how the compound effect from step 6 works, then you understand why it's all about how long your money stays invested. Another approach to investing is dollar cost averaging. It is a technique that allows you to invest constantly for a longer period of time instead of dumping your money all at once in the market. By doing so, you can average out the market volatility and have cash on hand to take advantage when the stock prices dip for various reasons. So step 7 is to start investing early and dollar cost average your money when doing so. Time is your friend when it comes to investing, but watch all the steps before starting. The 8th step is to buy the dip. In my opinion, there is no such thing as short-term investing when it comes to the stock market. I call that gambling. There is a saying, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. As I said in the previous step, no one can predict what the market will do next day, year, month, and so on, because markets react to human emotions every day. But if you invest with a 10, 20, 30 years horizon, the market keeps going up in the long run, as long as you invest in great companies. The number one reason why people lose money in the market is not because of bad investments, it's because of emotions. The only way to keep emotions in check is with high conviction. When the market is down, people panic sell, and when it is at all-time highs, they buy, because of fear of missing out, or FOMO. Remember what happened in March 2020? Now remember what happened afterwards? So step 8 is to be a long-time investor in great companies. Buy heavily when the market is down, also known as buying the dip, and then dollar cost average the rest of the time. But watch all steps before starting. Step 9 is to invest only in what you understand. Even though many great investors may disagree on what to invest in or how to do it, all of them come together in unison and agree that stocks are not just symbols with a monetary value. Stocks represent shares of a company, and no one should invest in a company if they don't understand the business behind it. Failure to get that from the beginning can mean the downfall for many investors. You don't have to invest in every company in the world and understand every company's business. It's enough to pick 2 or 3 great ones. Even the great Warren Buffett was quoted in an interview with CNBC saying that he was wrong on Google and quote-unquote too dumb to appreciate Amazon. The link to that article will be in the description below. There are many ways you can be a long-time investor, but the main difference is the amount of time you want to spend doing your own research. The easiest way to invest in good companies with little research is to invest into an ETF that tracks the S&P 500, or better yet, one that focuses on innovation like ARK-K. The second easiest way is to invest in companies you like and whose products you use daily, like Apple, Facebook, Google, Amazon. But the third and the best way, in my opinion, is to do individual stock picking by researching disruptive companies and understanding the technology behind them. So step 9 is to invest only in what you understand. If you want to invest in a fund, then research who manages it and what are the companies in that fund. If you want to be an active investor, then one should invest in disruptive companies. Step 10 is to invest in disruptive innovation. Before I get into that, I want to say congratulations for reaching this step. If you are still here, you rock. When it comes to technology, this is a great time to be alive. We are at the intersection of a lot of great discoveries that will change the world. There is a never-ending loop comprised of artificial intelligence, energy, autonomous electric vehicles, medical advances, blockchain technology, and so much more. The biggest disruption in our daily lives since the Industrial Revolution is happening right before our eyes, but most people can't see the forest for the trees, and for the most part is not really their fault. I say that because both the technology behind this revolution and its impact is too complex to understand as is. You need to invest a lot of time to filter out what is real and what is fantasy, and then to really understand each block and how they all can come together. Each year, Cathie Wood's Arcinvest publishes a report that states the direction that the fund is headed and what are the biggest ideas to invest in. This year, they are as follows: deep learning, reinventing data centers, virtual worlds, digital wallets, Bitcoin's fundamentals, Bitcoin preparing for institutions, electric vehicles, automation, autonomous ride-hailing, delivery drones, orbital aerospace, 3D printing, long-read sequencing, multi-cancer screening, cell and gene therapy, generation 2. I know this is a lot, but I promise we will tackle most of them together. So please subscribe, like and share so that your friends and family will have a chance to do better when it comes to their financial independence. So step 10 is to invest your money into the future, not into the past. Choose companies that are primed to disrupt legacy businesses. Always invest in disruptive innovation. Now, before I show you the bonus step, let's do a short recap. The last 5 steps are: understanding compound interest, invest your money now, buy the dip and dollar cost average the rest of the time, invest only in what you understand, and invest in disruptive innovation. Last but not least, as promised, here's the bonus step, and that is invest in yourself. I know this might sound like a cliche, but I kept this step last for a reason. It's the best and most important investment decision in your life. Figuring out how to invest in yourself can be a bit of a back and forth, especially when your main focus is to earn money. You want to invest in self-care, but when you do that, you're not earning money. This can lead to feelings of guilt, stress, and uneasiness. But always remember, the best investment you can make is in you. So here are some ways to invest in yourself and watch your life change for the better. Read books, articles, tutorials, and blogs. Watch YouTube videos about topics that can help you with your goals, and also subscribe to my channel. Join seminars, trainings, and mentorship programs either online or in person. Work out, eat healthy, and give yourself a break every once in a while, especially if you followed all 10 of the previous steps. You earned it. Meet new people as often as possible and develop a network of meaningful relationships that will help you in life more than you can imagine. That is it for now. Don't forget to like this video if you did. That will tell people that this is a good video and more should see it. Also, by doing that, you will appease the YouTube algorithm gods. Kind regards and see you in the next one.